following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today on 94.1 FM WNBU and cable TV 10 in New Bern. We also you may be watching the show off of our website, www.dlblain.com. We offer videos there of the show. You can also download the audio portion to your iPod or MP3 player, your phone, to take us with you. So we welcome everyone to the show. We thank Bob Register, who's doing the engineering for the show as always today. And we've got a good show for you today. I've been doing a lot of reading lately, and there's this theme in the investing world about active management versus passive management. You know, should you try to outperform the markets, or should you take a passive approach to the markets and accept the returns that are available? And, you know, there are arguments for both sides. We tend to lean on the more passive side. Over the past, 20 to 30 years, the markets have changed significantly, and there's so many people, there's so much information that's available at people's fingertips, to sit there and think that you have some sort of information that the millions and millions of other PhDs and MBAs and people around the world don't have is a little bit naive in my opinion. So I thought I would talk about some of the mistakes that investors make and how you can combat them and how you can achieve a decent long-term return in your portfolio. So let's talk about the mutual fund industry. A lot of investors, probably a lot of you watching the show or listening, invest in mutual funds. And over the past decade, large company mutual funds, which is in the United States, your biggest companies, the mutual funds that buy these large companies have underperformed the index. Let's say the S&P 500, which is a generic, there's nobody deciding, what to buy and sell on a daily basis. Just, hey, let's own all 500 companies in the index. Well, the average mutual fund has underperformed that passive index, by about 1% per year over the past decade. Even worse, if you look at the actual investors in the fund, and this is what's fascinating to me, is that they can look at what the fund returned, and then by looking at cash flows in and out of the fund, they can actually determine the return of investors in the fund. So for example, let's say you have a mutual fund and it has, $100 million, and it gains, 15% the first part of the year, let's say through October. And then all of a sudden people say, oh gosh, that fund is doing great. And so a lot of people join it. And so between October and December, you have $1 billion go into that fund. And then the market falls off and the fund loses 10% for the rest of the year. Well, in general, that fund made around 5% for the year, but the actual investors in the fund, the weighted average of the average investor, actually lost, 10% or so. So that's where you can look at the returns of the fund, and you can also look at the returns of the actual investors. Morningstar, which is a big financial data provider out there, they have a lot of information on this where you can look at and determine the returns of the investors. So anyway, investors have underperformed the mutual funds they invest in by another percent by poorly timing their purchases and sales. So you have the index that, let's say, makes 10%. The average fund in that space it invests in underperforms by an average of 1%, so they made 9%, and then the average investor in those funds also underperforms by another 1%. So they're making 8%, and then if you have to pay somebody, if you have an advisor that charges a lot or does very poorly, you've got another fee layered in there. So there's another company called D.L, and D.L has done more long-term studies, and they've shown that sometimes the investors in funds underperform the actual fund by 100%, meaning that if the fund made 10%, the investors are making only 5% because they tend to flit in and out of the funds. And so it's a good reason that we recommend passive funds, especially for people that are doing it themselves. You know, we use mostly passive exchange-traded funds, and occasionally we'll take an active stance in certain things, but certainly for individuals is why we recommend a passive approach, because the data just does not support individual investors doing any better than the index. And that's Jack Bogle of Vanguard. He built the whole Vanguard organization upon that premise. The same thing is true with investment newsletters. There's a great service out there called the Holbert Financial Digest, and Mark Holbert, he tracks financial newsletters. So when you hear on TV or radio or someplace somebody that has a newsletter, you know, the Blue Chip Investor newsletter or the Gold Bug newsletter or something like that, well, he tracks these newsletters to see who is doing better than the market. So in contrast to a fund where people are actually putting money in, certain people just run a newsletter where they just put out recommendations. Hey, we think you should buy Coke or Pepsi, but they don't actually manage anyone's money. So Mark Holbert tracks these, and 73% of the newsletters tracked by his service have underperformed a basic index fund over the past 30 years. And that figure is understated because he doesn't include newsletters that got shut down during that period. So once a newsletter gets shut down, he doesn't include it in his database. It's called survivorship bias. It's a bad problem in finance. The same thing with mutual funds is when you're looking at historical returns of funds, if a fund does very poorly, they're not going to keep it open. They're going to shut it down. Or if it's a big fund company like American Funds or something like that, they'll merge it into another fund and its history will just kind of go away. So it makes it very difficult to actually determine sometimes what the true story is. But anyway, so you should never underestimate how difficult it is to outperform the market over long stretches of time. Yes, on a short-term basis or a couple years or something, but over an investor's lifetime, it's very, very difficult to do so. And when you find a fund or something that has been outperforming, just remember, you've heard it before, past performance is no guarantee of future performance. And so what we want to do is talk about a few things that you can do to help combat that poor performance and maybe make you a better investor. Well, that brings us to our first break, so you're going to have to come back after the break to actually hear these pointers that we have for you. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.